Hey everyone, welcome in to another daily editorial here on the KE Report. I'm chatting with Adrian Day. We're going to be recapping a lot of the Q2 earnings out of the resource sector, especially focused on the major companies. Also, I'm going to ask Adrian about any opportunities he sees in some of the mid tiers, any of the juniors, and his overall view on the resource market, what he's seeing in terms of investors showing interest of any sort. Adrian is the president of Adrian Day Asset Management. I will post a link to that website in the show notes. He also is manager of the Euro Pacific Gold Fund. Now, Adrian, let's get right into Q2 earnings. Really across the board for precious metals companies, even a lot of the base metals companies, Q2 was a strong quarter. Now, a lot of this strength really is simply on the back of higher metals prices, but we did see some of the majors control costs quite well. Operationally, there were definitely some misses, but there were also some companies that did fairly well. So overall, I think we can say that Q2 was a strong quarter for the major miners, especially in the precious metals front, especially focused around gold. Adrian, what was your takeaway? Anything stand out to you in terms of those recent Q2 earnings that we've seen?
Yeah. Well, hello, Corey, and thank you for asking me again. I think you hit the nail on the head. Broadly speaking, the commodity price, the gold and silver price, was the major contributor towards good earnings where there were good earnings. But some of the companies are definitely controlling costs. Agnico has good costs. After a few disappointments with Barrick, their gold costs were essentially flat. They were up just a little bit, but that's because their royalty costs went up with the higher gold price. And so that's counted as a cost on their accounting. So their gold costs were essentially flat. Their copper costs were down. That's Barrick. So there were some companies that managed to control the costs and bring those down. The other thing you mentioned, which is certainly true, we know that in mining, as Robert Friedland likes to say, Murphy works overtime in mining. Anything that can go wrong is probably likely to go wrong. And mining is just a very difficult business. So anytime you have a company, whether it's a Newmont or a Barrick with lots of mines, or a company like one of the large royalty companies with lots of royalties on lots of assets, there's always going to be some that underperform. It's a lucky quarter if nothing went wrong at any of your operations. And so we saw that definitely this quarter. Several of the mines. But that sometimes presents an opportunity, and I don't want to jump ahead, but since we're on that tack, I mean, you look at Franco-Nevada, for example. Franco had lower results. They missed their expectation because two of their main assets, two of their main revenue generators, Candelaria and Antapaccay, had problems at the mines. These are not mines they operate, of course, but they have problems with the mines. Candelaria had already been reported, but then Antapaccay was new to the market when Franco reported. Now, in both cases, Franco said that the problems at those two mines were temporary and that both mines were running back to normal now. And Franco reiterated his full year guidance, right? Said these two problems at these two mines would not cause them to miss their full year guidance. And yet, what happened to the stock? The stock had its largest percentage decline in its history. It was a larger percentage decline than when Cobre Panama was shut down last year. Now, that's illogical to me. It is a reflection, and this, I'm getting onto a different topic here, but it's a reflection, I think, of just how skittish gold investors, holders of gold equities are right now. There's no great conviction, certainly outside of the gold bug community, of which I'm a member. Outside of the gold community, there is not a lot of conviction in holding gold stocks, and holders are very skittish. So when you see a company like Franco drop sharply on temporary issues, to me, that's a great opportunity to buy. And we've seen that this quarter, the second quarter, but we've also seen it very much over the last year. When a company has a miss or an issue, the decline in the stock price is really exaggerated and overdone. So just to look at this quarter, since Franco's one example, B2 Gold would be another example. I'm not suggesting that B2's issues are not real, but I think the market reaction was a gross overreaction. And B2, like Franco, is a company with a strong balance sheet. So you don't have to be worried that the company is going to go out of business because of what's happening in Mali, because of the cost overruns at Goose Bay. Another example would be Fortuna. Fortuna had well, they reported lower revenue than was expected. And because of that, higher costs. Remember, the two things often go together. So everybody says, oh my gosh, not only did they have lower production, but they also had higher costs. Well, yes, other things being equal, if your production is down, your cost per ounce will be higher because you have to amortize your costs over fewer ounces. It still was not a bad quarter for Fortuna, and yet the stock was down. So I think these things present opportunities if you're paying attention.
So, Adrian, let's dive a bit more into the reactions. As you outlined, shareholders do still seem to be maybe a little bit skittish. And even from your front, look, you manage the Euro Pacific Gold Front, you run Adrian Day Asset Management. I think you'll even admit that we're not seeing just a ton of new investors flood into this market, but the sector's doing well. These companies are generating some very healthy cash flow numbers. They're growing their cash piles. They're even paying off debt. Why isn't the market? Why aren't other investors taking more looks, taking note of this sector and moving into the majors?
Yeah, good question. I think things are changing. They're changing very recently and they're changing very slowly, but they are changing. So you look at inflows. Let's just look at the inflow to the GDX and the GDXJ, for example. But the same thing would apply to gold funds generally. I'm not allowed to talk about specifically what's happening with our fund if it's not been published or reported. But the same thing's happening with gold mutual funds generally. But you look at the GDX, VanEck publishes the flows on the GDX. And for the last month, when I looked last week, there were only 3 days in the last month that had net inflows. They had something like a total over the last month of 400 million in outflows in aggregate. And over the last 3 months, it's about 1.2, 1.3 billion outflows. This is astonishing when the gold price is where it is. So the question is why? Well, I think largely it's because the macro environment for gold stocks is still on the surface, not favorable. You've got low inflation and inflation coming down. You've got high interest rates. You've got an economy that is apparently still doing reasonably well. The consumer is still doing well, apparently. And of course, you've got a broad stock market is still doing well. So in that kind of environment, if you can become a millionaire overnight in Nvidia, why are you looking to buy Barrick Gold? That's the question people are asking. Now, of course, the environment is changing. We know interest rates in Canada, they've come down. In Europe, they've come down. And now the Federal Reserve in the US has said that but they're ready to cut interest rates. And everyone's expecting a cut in September. We know that the economy is slowing. You look at the unemployment rate moving up 4 times in 4 consecutive months, the unemployment rate moving up. And then we had that absolutely atrocious, outrageous jobs revision number last week. I don't know how much people in Canada saw that, but the Bureau of Labor Statistics, whose sole purpose in life is to collect statistics on the US economy, and they had a revision. They always have these revisions, but they had a revision last week, and they said that they overestimated job growth by 818,000 jobs in the last year. I mean, that is just astonishing. And so the economy is not as strong as it appears, and the numbers are slowly deteriorating. So the economy is slowing, interest rates are coming down, and the stock market, the broad stock market, has had a couple of stumbles in the last 6 weeks. And it appears that's not a one-way ticket to wealth anymore. And so as these things take hold, I think you're going to see more people start to look at gold stocks. I mean, people are going to start to lock in some profits on some of these long-term positions they've had in Apple or Microsoft or Nvidia, and they're going to look for things that are undervalued to buy. And that might be small cap value, it might be emerging market, it might be oil stocks, but some of it will also go into gold and silver stocks. And as you and everyone knows, the space is a very small space. If you look at all of the gold and silver equities in the world, we're looking at less than $600 billion. Compare that with the value of Apple or Nvidia. I mean, my gosh, Nvidia can rise or fall by 200 billion in a single day. So you only need a small amount of that money from these big tech leaders to flow into gold and silver stocks, and you can have pretty dramatic moves. But it's changing, as I say, it's changing slowly. But I think by the end of the year, I would expect when interest rates are moving down, when the economy is clearly slowing, when the stock market probably has another stumble, I would expect the sentiment towards gold equities to be much, much better.
Look, the fact of the matter is gold is doing its part. It just keeps on breaking out to new all-time highs. And while these stocks have started doing better, and a number of these majors are at least 52-week highs, they're still so far off of their all-time highs. It can be a bit of a real head scratcher. But can these companies do anything about it? Look, one of the issues is we've been in for these precious metals stocks a bear market, if not a flat market, for a very long time. Not a whole lot of wealth has been created. There aren't a whole lot of people tweeting about their portfolios and how much money they have made in precious metal stocks. But these stocks are doing what they need to grow their cash reserves, try to control costs as best they can. Can these majors or royalty companies do anything with this cash pile? What do you think they're going to do with this cash that they are continuing to grow piles of here, Adrian?
Yeah, let me answer about the cash piles in a second, but what can they do about it? I mean, the industry as a whole maybe could do something, but as an individual company, I mean, I think we have to recognize that mining, as I said, is a difficult business. There will always be problems, and that's just a fact of life. But I think what companies can do is try to perform better operationally and not provide overly optimistic guidance. So with more realistic guidance, the companies, I'm not saying they should cheat on guidance and always be ultra low so that they always beat. That's a silly game to play. But just be more realistic on their guidance. And if we don't have these continual missteps and continual misses, then I think the gold stocks will begin to gain some respect. Because remember, the people that bought in 2010, 11, the generalists, I mean, they lost 50, 60, 70, 80% of their money over the next 5 years, depending on when they sold. Well, if you're a generalist and you bought what you thought were the biggest and the best of the gold mining sector, and you saw that sector decline by 86% from the high in 2011 to the low in 2015, you're going to, and you could also blame company management for a lot of the problems, you're going to be very cautious coming back. So I think companies just have to perform and they have to meet their guidance. I think in terms of balance sheets are good. I don't think people look at the gold mining sector and say, oh my gosh, look at those horrible balance sheets. They need to bring debt down. That's not a problem. And as I say, costs are beginning to come under control. A lot will depend on what happens to the oil price, of course, and that's out of their control. But costs are under control nicely for most companies. Not a person that's overly. So if we look at the cash balances, You've got the royalty companies on the one hand, you've got the operating companies on the other hand. The operating companies generally, and the royalty companies with debt, have been bringing their debt down. So Royal Gold, for example, paid off all of their debt and is now debt-free, joining Wheaton and Franco as debt-free companies. Some of the big cap mining companies are also bringing down their debts. And I think, personally, I think that's the best use of cash that they could have right now, better than buying back stock. And so, to me, certainly better than increasing dividends. People don't buy gold mining stocks for dividends. And to me, if you're in a capital intensive industry, it is silly to increase your dividends and then have to go out and borrow money for some other purpose, for an extent mine expansion or something, because money's fungible. So in effect, you're borrowing money to pay a dividend, which is not a good idea. So I think paying down the debt, putting themselves in very strong positions for future growth is a good use of cash. On the royalty companies, you've got Franco's got 1.4 billion of cash, Wheaton's got a billion. But again, I think it's not a bad idea for them to hang on to that cash, because it puts them in a great position when there is an opportunity to just go out and buy the opportunity, to go out and buy it. And we will have opportunities at some point. So I think the companies will maybe increase the dividends a little bit, the royalty companies I'm talking about now. But having that cash available, I think, puts them in a very strong position for opportunities. So I'm not overly concerned about cash balances, frankly.
No, nor should we be. These companies do have some of the best cash balances they have had. I think a lot of investors still just wanting them to maybe go out, make some more acquisitions, but hey, they have builds that they need to fund as well, and they don't want to get into that situation that they did at the tail end of that last major bull market. Adrian, what about going down to some of the mid tiers and juniors with how, I guess, decently the majors have done? The mid tiers have really been the standout, and the juniors have done almost nothing besides a few select companies that continue to break higher. But 80, 90% of the junior stocks are still in very much a bear market. Where do you see opportunities in mid tiers or juniors?
Yeah, I mean, I think, no, you're absolutely right, of course. And the juniors that have performed, as you said, largely it's been very specific, because something specific is happening at that particular company. But first of all, that's generally what you would expect, though, isn't it? You would expect the seniors to move first, and you expect that to go down to the mid tiers and then finally to the juniors and exploration stocks last. And we were talking earlier about the fact that the gold stocks have hardly started to move. So it would be unrealistic to expect, the juniors to move. In addition to that, of course, the summer is often a soft period for junior and exploration stocks, because they're much more retail oriented. And so typically or frequently, they will have a soft summer. I think there's just some incredible opportunities among the junior stocks, but I would be alert to two things in my view. One would be the possibility of tax loss selling as we get later into the year, because there will be investors with large gains in other sectors who will be looking for tax losses. So we should be alert to that. And the second thing for me, and it's just the way I like to manage money, I'm very alert to balance sheets. So there's plenty of junior and exploration companies that have very strong balance sheets that are not going to have to go out and raise more capital. And those are the ones I would be focusing on.
Okay. Adrian, we'll wrap it up here. Look, fact of the matter is, it seems like this is a huge opportunity for investors to still get into the underlying precious metal stocks. The disconnect between where the gold price is, especially, and where these stocks are broadly, is massive. But I know we've been wondering for a number of months now, with the continued rise in gold and the lack of new investors coming into the sector. But all of this can take time, especially in this environment where we are still seeing the broad averages perform quite well. Yes, I know we can poke holes in that and say that the breadth isn't there, but fact of the matter is, if you are holding some index fund, you're probably doing pretty well because you are holding some of those outperforming stocks. But hey, right now, gold continuing to move higher. These stocks, they are doing well, but I think we're seeing too just how important it is for gold to keep moving higher, to keep pulling these stocks higher. Adrian Day, again, the president of Adrian Day Asset Management. I will post a link to that website in the show notes. Adrian, great chatting with you. We'll chat again soon.
Thank you very much, Corey. Thank you, ladies and gentlemen. Thank you.